Class is in session. Let's get started. I'm going to be talking real quick about syndications and partnerships and the general difference between the two. Some of y'all know I do syndications, so take everything I say with a grain of salt if it sounds like I'm trying to pitch you. That being said, it is a pretty good way to invest if you don't want to do any work. So usually the first question people ask is, what is a syndication in the first place? Syndication's a way to raise money that's regulated by the SEC. The federal government basically created this body to say, hey, you guys want to raise money? There's a legal way to do it and a legal way that you can't, to protect investors, basically. Usually in a syndication, you only have 1 to 6 people in charge of the daily operations, and then several other people who are just investing passively. An LLC usually is then made to hold the real estate. I get this question a lot too. And then people own shares in the real estate. So, they own a portion of the company that owns the real estate, not splitting the title necessarily in a way that all maybe 100 investors are involved in the deal. So it's the property's owned by one LLC, and then the LLC is owned by all the investors, right? And people split it based on equity and profit, which I'm going to go over in a little bit as well. Then you have the joint partnership, joint venture. This is something that a lot more people have heard of, which is everyone has equal standing within this LLC or project. This is actually just a business entity. You don't need to be regulated by the SEC. And that's because the assumption is that everyone is a material participant. They're involved in running the project. You're usually required to all co-sign on the loan, and therefore no one is passive, right? The government doesn't think you need 100 people to run a single family home. That's why when you can partner with 2 or 3 other people, everyone is more or less involved in the operations of the property, quote unquote. And so why do people do JV over syndication? Because it sounds like syndication, if you're just investing, you have no control. Well, with a partnership, they kind of expect you to be on the loan. And if you don't do it where they're on the loan, they can technically sue you and say like, hey, this is securities fraud. I'm a dum-dum and they just took my money and it went poorly and it's their fault. And so technically it was a security, but it wasn't explained as such. So usually lenders and SEC will cap it around 6 people, but Stella, our friend at Fractional, has found a way and a loophole such that everyone involved is a material participant through this voting system that they have on Fractional. I'm pretty sure it's legal. They have legal counsel from someone who was an advisor to the SEC for a long time. And so as senior counsel, I'm guessing they have an idea, after going through Y Combinator and whatnot, what is legal in terms of how you can have a joint venture with more than 6 people. It's a general rule of thumb, but in this JV, just a reminder, no one is supposed to be passive. Everyone is supposed to be an active participant in the deal, technically, to not be a security. Now, what could go wrong? Well, I want to bring up my friend Mohit. He's going to go over a story, a brief one, about his own experience dealing with a bad syndication. But basically, the main issue of what could go wrong in a syndication is 1, you could lose all your money. 2, they ask you to put more money in the project because it's not going great. And then 3rd is you then lose that money that you put back in to save the project. And the worst case scenario is if it's actually a joint venture and you're on the loan, and now you actually owe the bank more money than the amount you invested. There's also a worst case scenario, which is you lose all your money because it was a scam. And so Mohit, are you in the room yet? If he's not, I'll ask him to talk about it later. But he's got a story about basically being scammed in a syndication. And what happens in that scenario is you have to sue them. It's bad actor clause, and it happens sometimes, but I think what he said was his family got into a Ponzi scheme. So you got to keep track and watch out for scammers like that. So what do you usually have to watch out for in a syndication? Well, one, you got to figure out what the deal is, right? Then you're going to have to figure out who the operator, the person running it is, because usually there's supposed to be only one person running it. And then you got to learn to analyze real estate markets, the neighborhoods you want to go into. Richard, you raised your hand.
Yeah, I wasn't sure if this is the appropriate time to ask questions. If not, I can wait until the end.
You know what? I'm going to say, feel free to ask questions so it feels like we're interacting and I'm not just speaking to the void.
Awesome. I think Zoom already takes away the networking component, so I might just speak out loud. And a brief intro, I'm Richard. I'm based out of the San Francisco Bay Area, and I invest in multiplexes around the nation. So my question around joint venture, Nelson, is I've heard through, not through personal experience, but I've heard through others that you could arrange it so that you have two joint venture partners. One provides the money and the other provides the mortgage capacity. So yeah, I wanted to get clarification on that. Thank you.
You're technically not supposed to do that. That's what I'm saying. And if at any point the capital partner, the one who invested, who has no controlling stake, decide to step in and say, hey, I was defrauded, this is securities fraud, you get blackballed by the SEC and you can never raise money again through even legal syndications. That being said, people do it all the time because the expectation is I'm partnering with friends, partnering with family. This guy won't sue me, right? And so you're not worried about it becoming securities fraud. But the legal definition of a security is that one person's doing all the work and you are investing in the hopes that you gain profit, but you don't provide any material participation. Usually you're supposed to ask the other person to sign on the loan to make it seem more legitimate, like they're an active participant. So even if they're not actively participating in it, they have the option to make decisions and make material changes on the property. Does that kind of make sense?
It does. So even in the case where we create an LLC and we put our names, let's say me, I provide the money and the other person provide the mortgage capacity, our names are on the title. That kind of arrangement is still not legal because one person has more control over the other in a way.
Correct. Technically, it should just be you get the property, you hold the property in the LLC, and the title goes to the LLC. And then everyone has some sort of shared ownership within this LLC, where the structure is you have partners in the LLC who have control and have the ability to make decisions if they want to on the property. That's why Stella made this fractional app, because everyone votes, therefore they all have material participation within the management of the property.
Got it. Okay, thank you.
Sounds good. Cool. Mohit, did you hop in the room yet?
I am here, yes.
Gotcha. Mohit, you want to tell us your story?
Oh yeah, lovely. Cool. Yeah, so be careful with syndications. I mean, I'm not saying don't invest, but do be wary. So my personal experience with this is that my parents, we own, I think like two single families as investment properties. And then in 2014, we started to invest passively as LPs in some commercial funds. Now, this was going great until 2020 when COVID happened. And then what we were doing was investing in a local developer here in the Bay Area. And all of a sudden distribution stopped because the whole world shut down. And then after about 6 or 9 months or so, some of the other projects that we were involved in from different funds, they started to return capital back. This particular fund did not. And then all of the other investors didn't get their funds back. So this prompted a whole investigation. And then now the SEC is involved. And the SEC has basically filed it's either a judgment or a lawsuit, one of the two. But he's basically being investigated for defrauding 120 individuals to the tune of 130 million, or 300 individuals to 130 million or so. Yeah. So be careful. Do your due diligence. it's messy, and you may or may not see all of your capital back, especially when you're investing like six-figure sums.
Yeah. So what would you do now different in terms of your due diligence when it comes to finding a good operator?
So obviously do your due diligence on the deal itself, like run like your own models, talk to other people who have invested with people like them, get your own legal counsel just to review all of the offering docs. This is optional, but I mean, now I've started to realize that a lawyer, like me paying a lawyer between 250 and $500 is totally worth it, just because they might, and excuse my language, but it might save your ass. So I mean, a bad syndication deal, like my family invests maybe like 500,000, and that's money that we can't really, like, we borrowed it because rates were cheap. We were getting 15%, but he was robbing Peter to pay Paul. So it turned out to be a whole Ponzi scheme. I'm sure that it happens more frequently, but I mean, get status updates, try and see if there's a personal relationship, try and see what other projects the syndicator has done, try and look them up yourself if you can. And I saw that there was a comment as well.
Yeah, I got it. Ari asked if it's not a scam, would it be relatively safe? Someone who's been in real estate for 20 years has never lost money. I got to ask you, have they ever raised money from other people before? That's different than they've never lost money for themselves in 20 years. That being said, it's very difficult to screw up right now. Just from what
hot shot. Everybody is cool.
Making money. Yeah.
If you bought in Phoenix in like 2016 and you sold in 2021, you're probably like 3 to 4 extra capital, and you're not a genius.
Yeah. And so I'm going to explain basically how to analyze if this person was a good operator or not. It usually has to involve looking at their prior financial projects and then going from there and seeing whether or not they can explain it. But yeah, there's really 3 parts to each syndication. There's a deal, there's your operator, and then there's your market. One way to tell how you're getting paid, though, is through your overall returns. And there's 2 ways you get paid. One is usually the preferred value, the preferred equity returns. And so there's this distribution you get from the rental income. And the other thing you can look at is the equity split, which is shared from the increased value of the building, right? There's 2 parts to it. In commercial real estate, it kind of boils down to this one simple equation. I know there's math, people don't like math, but you got to learn this one. The market value of your property is equal to your net operating income divided by the cap rate. So market value, everyone knows what that is. Your net operating income is your income that you generate. So revenue minus expenses, not including the cost of financing. So any of your mortgage payments is not involved. It's only how much money does it make, revenue, minus how much does it cost to run the place, not including your mortgage and your financing costs. And then that is divided by a number called a cap rate. A cap rate changes based on the city, is it A class, B class, C class, right? The more valuable cap rate, the lower the value is. What that means is the value of the dollar, each dollar generated, is worth more in, say, Phoenix than it is than, say, Detroit, right? That's just what the cap rate is. If a cap rate is twice as high as somewhere else, that means each dollar of income that a property generates is worth half as much as the one that had the lower cap rate, right? So how do you get paid? How does the value of the building go up so you can get the equity split? Well, usually you have to increase the income, right? If you increase your net operating income, you increase the value of the property. That usually tells if you have a good operator. If you look through the financials and you see, their underwriting, did this person actually increase income? I saw a deal recently where someone bought into a deal in Austin 2018 and they got 30% return, but their net operating income went down. So how did they get returns? How did they make all that money? Well, the cap rate went down, right? The valuation of each dollar that they generated shot up in Austin. Everyone was throwing money in the city, right? It's where I live, so take it with a grain of salt. And so because the value went so much higher for each dollar, the market value of the property just shot up. And that's how you tell different things. And ideally, you're investing in something that has both, right? A good operator and a good market, right? That way you can figure out in good times and bad times that you're making money. And so that's kind of where it's at. Sumiko also mentioned that she checks someone's background in order to see if they had past court cases. Apparently you can just go to judyrecords.com. It's a free resource. You can search through court cases in the country. And so
they're like stopping it as of now, but yeah, there are other things like I'll post all the others that are more paid, or you go to each of the states court search system, which is really cranky, hard to use, but you can also do that as well.
Got it. Okay. Richard, you raised your hand.
Yeah, so the cap rate is well, you know, I have a general sense of what the cap rate is, but that might not be what the appraisers have in mind, right?
Correct.
So yeah, how do I read their mind?
To clarify, there's a market cap rate, and then there's a cap rate that your building is generating.
Right.
Right. There's two differences, right? The market cap rate is what everyone else is paying per dollar amount. And then you have your own cap rate based on how much you paid for it and how it's changed since then. Right.
Yeah.
Those are two different things. You have your entry cap rate, your purchase cap rate, and then your reversion or your exit cap rate. The exit cap rate is the number that matters, because that's how you figure out what the property is worth, you know, once you're done selling it. Right. Ideally, you're buying an apartment or an industrial facility where the rent is less than what the market is. Right. And so you're going to increase the rent, and assuming that the cap rate, you know, might be not as great. Well, the thing is, you're not thinking about the cap rate you purchased at. If I buy a 2 cap today and I can push it to a 6 cap, you know, without much work, sometimes it's kind of worth buying it at a 2 cap, even if the market is, say, at 4. So let me reuse words that sound easier.
Yeah, stuff delivered.
Oh, and
I'll check it.
I'm going to mute you. All right. So say you have a property, and this property is going to be worth $100, right? Based on the income that it generates. I am paying, I don't know, say $60 for it, but it's $60 because no one's living in it. And because of that, the income that I'm buying it in at is extremely low, right? I'm overpaying for the amount of income that I can make, but it's $60, right? It should be worth $100 when I'm done at the end of the day, right? And I can calculate 100 because I know what market rent is and I know what market cap rate is. That is my finished product. That's the same thing as an ARV if you're used to residential properties. And so all I need to calculate then in terms of how much equity I can make is what is the end product, right? What's my final income and what's my exit cap rate? And then what's my purchase and rehab? Everything in the middle, that's just profit.
Understood.
Cool. All right.
Thank you.
That's what. All right, I'm gonna give a bit of an example now so you guys can figure out how you get paid in a syndication. I mentioned preferred return and equity split. So let's say I have a deal. I should probably go over this slide first. I have a deal. This is the whole project. 75% of it is the orange loan and 25% of it is the blue investor capital, right? Just to give an understanding, like I'm just buying a real estate project and, you know, I'm putting 25% down. That's what it is. Now, let's say we invest 100K. As a Sayre homie, there's only 5 spots in this whole deal. And I am one of those spots. I'm the blue spot in the middle. So I invest 100K. Now, the person who is running the syndication is offering an 8% preferred return. Now, there's 2 ways that this can work. You can do a value add, which is usually a building that already exists. A preferred return is kind of like a loan. If you have a pre-existing building, usually they pay you 8% each year if you have an 8% preferred return, right? So I invest 100K, I'm getting 8 grand a year back in the pocket through the rental income and distributions, right? Supposedly, I'm supposed to be getting that. If you are being careful and you're checking the underwriting, then you'll figure out, hey, it looks like cash flow is only like 6% this year. How are you going to pay me 8% if you can't make 6%? Well, fun fact, with a preferred return, it's not like a loan. They don't have to pay you 8% each year. They can pay you 6% one year, 7% the next year, 8% next year, but it's money that they owe you before they can take any for themselves, right? So if someone says 8%, maybe it's an average of 8% over the life of the project. And so that's what happens in, say, most new development projects or heavy rehab projects. I invest in new construction. So if I put 100K and it pays 8% pref, they owe me 24% at the end of year 3. They just don't pay me until the project sells, right? So kind of like a loan, they owe me the first 24% before we do any splits of the equity. Does that? And so if, oh, John, you raised your hand.
Hey, I have a question. Sorry to interrupt everyone, but would this calculation then, does it just not assume any compounding time value of money calculations then, or are those also baked into some contracts?
Correct. This is simple IRR. There are some that compound, but most of the time what they do is a simple flat interest rate over time. So if you're somebody who does a lot of math, you'll know the time cost of money is worth less over longer periods. And so it is a flat 8% though. And so
so I could assume that when I look at these contracts that the most popular approach is non-compounding, right? Like, okay.
Great.
Thanks.
Right. And so this is something you got to be careful about is just, you know, they'll give you a preferred return, but you got to ask them, what does it actually look like each year, right? If there's a heavy rehab, a lot of times year 1, they don't hit the pref because they're doing so much work on it that they can't really pay distributions. And then after year 2 and 3, they catch you back up, right? But sometimes you want day 1 pay. And so I have a syndicator that I invest in for that. I like day 1 cash flow sometimes, but I also diversify in the new construction where I'm okay with a 3-year payout, right? But this is a general example of what a preferred return is going to look like. So what is the equity split part of it then? How do you share in the profit? Well, the way I'm going to explain this is there's 2 parts to it. You have, say, this original purchase price of the project. I don't know if you remember the colors, but you have your loan and you have investor capital. I got to spend that money to pay off the loan, and I got to spend it to pay off the investor's original money. You invested 100K, I'm getting 100K back as the Sarah investor. But the value of the property's gone up. So now it's a bigger square, right? Does that kind of make sense to everyone? And of this bigger square, here's the actual profit that we can split between you and me if I'm the syndicator and you're like the LP. I have to pay back the preferred return first, on top of paying back investor capital and closing costs, right? These are all things that are factored into the actual return of the project. And so once all these costs are paid off, what's left over is actually split up between general partner, limited partner. Usually the general partner, limited partner split is 30-70. I've seen bigger projects and more advanced syndicators, they take 40% sometimes, but it's because they can still give better returns for the LPs than if they took a smaller cut, right? And so it really depends. Every deal is different, but usually it ranges between 20 to 40% that the syndicator will take a cut of this finalized profit portion of. So it's not like you give them 100K, they take 30% of it day 1. They usually have to return the 100K, and then everything up after the returned 100K and your preferred return, that is split 30-70 for general partnership, limited partnership. Okay, so now let's give this example a little deeper. So say I made 100K investment. I get my 8% payout year 1, 8% payout year 2. Year 3, they return me my original 100,000. I get another $76 in profit from the LP share, and I still get my 8K from the preferred return that they owed me for year 3, right? So this would give me an overall return of like 100%, right? Like hypothetically, this is how most syndications are supposed to be structured, where you can double your money around 5 years, right? Most indicators will say I can do 14, 15% return based on this model of paying you out 8% a year. And then when the project sells, most of the profit is usually in the project being sold. Some people don't care about that. They want bigger returns, and so they'll do new development. So the year 3 pop is bigger than in most value add projects, right? But other people who want to retire and live on cash flow, like value add is probably the best bet, because 8% return from distributions, like what stock returns? It's like, 7-8% a year too, right? So imagine this, but you don't pay taxes on it because you actually can take depreciation bonus, or you get the depreciation of owning the real estate, because unlike a REIT, it's not just a stock. You're owning a portion of the equity of the LLC. So any write-offs can actually pass off to you. This $8K that they get from distributions is untaxed. And so because you own an equity stake, it's a bit better than most REITs that you could just buy on Robinhood. The downside is it's a lot harder to trade. Usually you have to find somebody within the group willing to buy up your share, or you have to find an accredited investor to take over your position, or you just have to wait until the project sells in year 4 or 5. And so that's the risk with syndication, is less liquidity, but higher returns, right? And so if you can get 8% payout each year, you're already beating the stock market. Then on top of that, you make money from when the project sells, right? Because you've created value by increasing the value of the property. So this is an example Burr project. When I do projects in Chicago, this is kind of how I do it, because we usually buy stuff at 60% of what the value should be based on the market rent and market cap rate, right? So we know what it's going to end up being worth when we're done with it. We just have to buy it at a lower value. So say you start with a Burr project. I invest 100K year 1. So then year 0, I'm sorry. And then year 1, year 2, I get my original money back, say the 100K I invested, and I still cash flow. However, the cash flow amount is smaller because in order to refi me out, we had to take out a bigger loan. For those curious about what Burr is, it's been popularized with Bigger Pockets, but it's basically you buy the property, you rehab it, and then you refinance after you rent it out. So the best example I can give is you buy the property and say you put 20% down. So I put $20 out of $100 down. When I'm finished rehabbing the property, it's worth $20 more. So I just refinance out that original $20 that I put in, leaving behind some equity in the project. But now I can take my $20, repeat, and buy another property, stack more cash flow, right? And so this works a lot better in cities that aren't very popular, places like Phoenix or Texas or Florida. It's a lot harder to find Burr deals on the multifamily side, just because there's so many people looking. But if you're in Chicago, where no one's really competing with you, or places in the Midwest, you don't really get a lot of competition. And so you can pick stuff up 50, 60% off. Mohit's giving me a little, this right now. Mohit invests in Cleveland, right? And so he's running into some competition now. I doubt it's competition like Texas though. So
it's not Texas or Phoenix level. I like Cleveland because there's not that much competition. But when you Google like best cash flow markets, Cleveland always comes up. So
yeah,
like you can't have your cake and eat it too.
Yeah. That being said, if you do the Burr where you refinance out and pull your original capital back, you get your 100,000 back to reinvest, but you get less cash flow as a result, and you've actually left the $76 at the end, so that when you sell, you can pull that back out. But right now, you've actually left $76 in the project because you've done the Burr, right? So some people are okay with that because they don't want to pay the capital gains tax the moment you sell it. So they'd rather hold it for longer, get the original capital back, and stack cash flow. And so for some people who want to get straight into like retirement without worrying about scaling a bunch of dollars, buying cash flow and recycling as quickly as possible is the best way to put yourself out of work. But there's other people who want 1,000 units and have their last name in gold on a bunch of towers. That might not be, up your alley. You want maximum equity instead, right? You want that $76 back as quickly as possible. Someone asks, what's the tax form you get when you invest in syndication? It's called a K1. It's basically a partnership form. You take the K1, give it to your CPA, and then they'll help you figure out what you can use to write off. If you already have pre-existing real estate, you can actually take the extra write-offs from, if you do bonus depreciation on a syndication project, you can use that to write off real estate you already have. Richard, you asked a question?
Yeah, I have a question regarding a prior slide where you showed how if a project gets, if you make more money, and then the waterfall of the payment. So does the order go like you have to first return the investor's capital and then the paying off the loan, and then it goes to the preferred, and then GP and LP split? Is that the order that money gets returned?
Yes,
Okay.
generally yes. Again, this can change depending on the syndication project, but normally I see that this is the template that most people follow, which is I give you back your money and I pay off the loan and my costs, and then I give you preferred return. The whole point of preferred return is that no one else can take money out until that is paid. So it is a cost of running the project, and then everything left over is split GP LP. I've seen some projects where there's no preferred return, and people just do a straight 20-80 split as well. In that scenario, because there's no preferred return, you just pretend this doesn't exist, and you just split it exactly 20-80, and they don't actually return your capital first. You keep the capital in the project, and you just split all the profits 20-80 as the project keeps going. So some people like preferred return for that reason, which is that I'm gonna get my money. I'm not gonna wait. I don't want to deal with all this other stuff. So
and if you do a BRRRR, like let's say whenever there's a liquidity event like BRRRR, right? Like you refinance the money out, that should be the sort of the pre-agreed upon order of waterfall, right?
So I have a project where basically we pay out the initial equity return, or sorry, the initial investor equity. So if I give you your 100K back, there's no longer preferred return anymore, by the way, to clarify. Preferred return is there as long as you have investor equity. So if somebody does a liquidity event or of some sort, or a capital event where I refinance out, give you back 100K, that 8% is no longer like a guaranteed amount that is owed before the project sells. It just becomes a straight, 30-70 or 20-80 or however the equity split goes, right? Preferred return is structured as usually kind of like an interest rate for the loan that the investor gives. And so that might be something to clarify with the syndicator. That's how I do it. So, maybe not everyone's. Some people.
Can I ask to re-clarify that again? That 8%, for example, preferred return means the first 8% of the gross income goes to the capital partners, the equity partners?
Correct. It's 8,
correct. Okay.
Yeah, the first 8% each year.
The first 8% per year of the net operating income or the gross rent?
Sorry, it's not the net income or the gross income. I misheard. It's actually 8% of the amount you invest.
It's just like an interest rate. Okay, then you just pay them an interest on their money essentially.
Correct. Yeah, sorry, I misheard you.
Oh, sorry, I misheard you. That makes a lot more sense to me. And I guess I don't know if I've seen structures where it was like off of the gross rent or something instead, but I guess that could be complicated.
Yeah, no worries.
No worries.
Good question. So Jezebel Trulove asks, will the preferred return in LP profit depend on how much one invests? Yes. So I have an example here that I showed earlier. So say I have 100%, so I have a project here and it's a 30-70 split. So this is the 70% split that's left over for the passive LP investors. I only invested 1/5 of the share. So I get actually only 1/5 of this whole chunk. Does that kind of make sense where I'm going with this? Like, so this might be the total amount, but it's split, you know, of the 70% left over on the LP profit, it's split based on how much of the money required I put in. All right, cool. So if that works, I'm just going to keep going.
So I'm sorry, I didn't follow that. I'm sorry.
Oh, sorry. So let me come back here. You have a GP share of the profits and you have an LP share of the profits, right? So what I'm doing is I took the LP share of the profits, and the example I gave earlier was that I, as the share investor, am investing in one of 5 spots, right? That are 100K each. So because I'm one of 5 spots, I only get 1/5 of that final profit. And that's where this dark green square of the sale of the LP profits come in after everything's been paid off. If I were to invest 200K, right, I would make 16K per year, right? It kind of adjusts based on how much money you put in, but the 8% pref is attached to the original amount of dollars that you put in the project. So if I put $100, I get $8 back. If I put $200, I get $16 back. Troy did ask for this example. If the deal makes more than net profit in 1 year than 8K per investor, where does the surplus profit go? Since the LPs haven't been fully paid back yet, does it all go back to LPs? So it depends. Technically, once the 8K is paid back per investor, everything above that, you're supposed to split based on equity, 30-70%, right? But if you're the syndicator, maybe you're like, I kind of want to start paying back people their original equity first. So they might use that to pay off the investor portion of capital. But technically, what most indicators do, if you make more than 8K per investor, then you just take what's left over and you split it 30-70, that LP GP profit share.
But that, if you start paying back the investors, then that reduces their equity trap in the deal and therefore reduces the dollar amount of the preferred returns. Is that correct?
Correct. And so it depends. Oh, sorry. Yeah, and so
Listen, let me jump in for a sec. So I know this is 101, but this is Christoph. So I know this is 101, so let's keep it a little bit simple, but let me address the question. When you read your PPM, you have to be careful what they're writing into. The topic the question you're asking is now the difference between return on investment and return of investment. So without going too far, I'll just cover it real quickly. If it's a return of investment, what the GP is doing is giving your original money back to you, okay? Which is not a taxable event if I just give you back your money, okay? Therefore, that implies your equity will go down, okay? So in this example of $100, 8% pref, if I gave you back your original $8, now the 8% is based upon $92, okay? Return on investment, your equity does not go down. I pay you $8, you still have $100. However, that $8 now profit is a taxable event. So just read the PPM, it changes differently.
yeah, let's go back to the 101 portion. This is getting too complex. Each deal is going to be different, so it takes a little more effort to read between the lines. For example, I have a friend who does 20% pref projects with no equity split, but after they're done with the project in year 1 or 2, you're out of the deal once they give you back original capital. So, you know, you can make 20% 1 year, but after that, it's like you're cut out of the deal. You get no upside and they give you back your money, right? And so it's kind of like a loan almost. But again, because it's preferred return, they can pay you back honestly at any time. They don't have to pay you back at the guaranteed, or they don't have to say like 1 to 2 years guaranteed, we're going to pay you back unless it's a loan. A preferred return is just money owed before any profit can be taken out. So, okay. Drew Ogden also mentioned the actual preferred return or even the profit split can be different depending on investment amounts too. That's correct. So some people, if you put more money than others, you can get a higher preferred return, right? It depends on the deal. Some people will say you'll get, 10% if you put 500K instead of 50K. The 50K people only get 8% preferred return, right? So They do have staggered levels, but every deal is different. And let's go back to 101. So, okay. That being said, I wanted to go over an example project, one that we're working on. It's called the Sterling and San Marco in Jacksonville. So here's a business plan. We came in, we purchased at 120 a unit, and it was operating at a 2 cap when we purchased it, basically. The market cap rate is around 4%. So what does that mean? We bought it very expensive, probably twice as expensive for the income that it's generating. However, we're okay with that because within a few months, we pushed it to around a 6 cap. Market cap again is around 4.5, 5 cap. So, we've pushed income higher than, what the market was when we purchased it. And that was our goal at the end of the day. The business strategy was that somebody already done all the rehab. They just weren't managing it well. It was a New York manager. And so we bought it high, but we pushed income high as well, right? And so that took us over the level. We only converted about 12% of leases, but originally we were only trying to do 1,100 for rent. We're hitting 1,250 now. Chris, is it okay if I show the underwriting very briefly? Okay. I'm working with Chris on the project, so that's why. Either way, so the idea is that we're pushing rents above the pro forma, and we're hitting even higher rents than we originally intended to. After only a few months. And so we're kind of
flash the underwriting, and then we'll send out the public version so everybody can have it.
Okay. And then operating expenses around 45%. There's a few underwriting tips that I have on the Notion. I'm going to send a link to everyone else to check later. We can go over them as well, but I figured it was too much work to go over and explain to everyone. So let's see. Show my screen.
We'll do a class of 201 for underwriting. We can deep dive into some of the what makes the number work there.
Okay, so there's a few parts when you're syndicating that you're gonna get. So I'll start with one. Why did we pick Jacksonville as a market? So as you can tell, here's the 2 markets that I'm in. This is a dashboard that I made for myself. I'm going to go over this very briefly, but basically you can estimate and, oh, what's going on here? Yeah. So
you put it on Facebook, so you had to really flash it quick.
Yeah, it's screening real quick. Okay, either way, we're at a 6 cap. How do you figure out what cap rate is? Google is your friend. So we're looking at Jacksonville cap rates. It's around 4.5 to 4.5 to 5.5% cap rate. The fact that we pushed it above the market cap means we're earning more income. We now have a discount on what we purchased it at, right? So that's the overarching idea. We're C class, we know that, and that's fine. We just cared that we were able to increase income to what it needed to be so that we can start paying ourselves out. How do you figure out what market is good? Well, ideally, you want to be in a market that's not very competitive and that's decently priced. So this is a dashboard that I made for myself to keep track of how properties are doing, and how different markets are going. So this is how rents are changing each month, perks of being a programmer. So Jacksonville, as you can tell, is actually kind of in line with the rent change that Austin is having. So rent increases are the same, but Austin had this massive price increase. This is the Z estimates. And so this is kind of like a rudimentary way to measure cap rate, but my rent is increasing, but Austin is increasing even further, right? The growth rate was double for quite a bit of time. And so Jacksonville is technically a discount. And even though, it's a market where there's still strong growth, so income growth is still pretty high, and population growth is also still picking up. At the end of the day, it's a good growing market with decent economy. And so we figured, all right, this is a good place to park our money. Now, that being said, we did some math on the pro forma. So I'm going to go over it very briefly, but our target goal is to hit 45%. A lot of people will say this isn't conservative enough. I think that's because a lot of them are in Texas where the property taxes are higher. So expense ratio is something you got to keep track of. Rent growth is something to keep track of. We usually keep this under 3% just to be conservative. And then loss to lease is, you know, what the rent should be like at the total market rate versus where we're at. And we kept that at 12%. Most people do 10.
Yeah, then one little piece since we're on here. If you look up Google, rent growth in Jacksonville is in the 15 to 18%. We're underwriting at 3% rent growth.
Yeah. Jacksonville is up 31% according to the Jack's Daily Record. So, but yeah, so we made a lot of money. We're pretty happy about it. And right now we were looking at this property in Jacksonville. It's going for $190 a unit. We purchased it at around $120. This is 2 miles away from our property, right? 2 miles, was it, Chris? Okay, so that's what makes it exciting, because now we kind of got ahead of the curve and now everyone else is kind of following suit. And so if you check our rent roll as well, actually, yeah, our rent roll, we have only turned over about 12 of the units. We added 5 because there was had a lot of vacancies when we bought in as well. And so I don't know if you can tell here, but new rents, yeah, we're hitting $1,250 and $1,425. And here, I'll hide the rest. So
the takeaway is don't get hung up on the cap rate you're buying, because at the end of the day, the right business plan, we're now 6 months into ownership and we're talking about cash out refi already.
Basically a burr.
Yes.
Yeah. And so let's hop back in. So now back to this project. We went from 2 cap, we pushed to 5.7. Exciting times. Rent, we've only turned 12% of leases and we are already pushing from $950, which is what we bought it at, to $1,100, which was our target. And now we're re-signing them at $1,250. We recently just rehabbed the building, a 2-bedroom, and we got $1,425 on a 2-bedroom. So we've been increasing rent around 30, 40%, kind of in line with what the market rent was doing. This is why people are saying invest in multifamily, because it's a good hedge against inflation. As inflation goes up, so do rents, and therefore the values of the property. The income has gone up, even if the cap rate stays the same, right? So a 30% rent increase translates usually to at least a 30% increase in your NOI. So, and then our operating expense ratio is around 45%. I made a red flag to check in the Notion. I'll be sending that link out after this, and then I'll share the screen on that as well. But if your operating ratio is usually around 50%, that's how you become conservative. I personally prefer 50%. Chris uses 45, but I can see his argument. It's everyone has a different way of seeing and figuring out what is a good deal and not. And the thing is, I can't do this all in 101 because every asset class has different numbers to keep track of, and every operator has different numbers that they can hit. Right now, we're operating at 45%, which is the low end. So that being said, I'm going to talk about stuff I invest in. What are my positions? Right now, I'm in tech. Winston, you raise your hand?
Yes, sir. Hey, how's it going? Awesome job here. I thought this was pretty interesting. I usually see maybe investors purchasing at a higher cap rate, like 6 or 8%, give or take, or kind of like underwrite deals so that they can get like 6 or 8% or somewhere around there, and then maybe try to exit at a lower cap rate. Does that make sense? Has that been one of your strategies?
Yeah. So I know what you're saying.
That right?
No, I know what you're saying. So there's a difference between buying a property that's already stable and a property that's got meat on the bone. If you're buying a property where you can't really push rents any higher, you want to get the highest cap rate possible, right? Because you're already at market cap and at market rents. So if you can't increase market rents, you don't want to depend on cap rates changing so that your value goes up, right? Usually when we underwrite with the cap rate increasing, right? We're selling it for less than the income that we're buying it at. And so the reason the other direction is their assumption is I'm going to buy it just discounted, right? You're a wholesaler, right, Winston? So it totally makes sense.
Yeah.
If you're at like a 9 cap, but then you're selling it at a 7 cap because that's what the market commands, right? So for you guys, it might make sense to buy a 9 cap because a lot of times you might wholesale from a building that is already doing pretty well and you're just trying to get a discount on the building. Whereas for us, we're trying to find stuff where, you know, we might be buying it expensive, but it's because we know there's so much meat that we can push, income that we can increase, that we can justify pricing now because future valuation is there.
Got it. Makes sense. Appreciate that.
Cool. And partially that's because rent has never really decreased. You know, knock on wood.
Right. I know, right?
I don't know if anyone's seen the graph, but historically rent has gone like this. Even in the recession, it went sideways and then it went right back up. So just a quick heads up. All right. So what are my positions? I invest in SpaceX and Plaid. The way they do it, they don't have preferred return. They do equity split, the profit split, right? I'm paying 20% right now for Plaid, and I pay, I think, 30% for SpaceX. So, you know, I went through brokers on this one. It's kind of like real estate. And you're saying, well, it's like, if I'm used to paying nothing on Robinhood, why do I have to pay a percentage of the profit split? It's because it's private equity. None of these are traded on the stock market. So if you're paying 20% or 50%, 50%, by the way, is what Goldman Sachs charges if you're a client with them and you're trying to buy stock in like SpaceX, Plaid, or something privately held. Usually the reason for that is because you need somebody to do the work to find previous equity shares from either early employees or investors, or, you know, you're friends with Elon Musk, right? That you need to buy equity from him directly, right? So there's usually a middleman broker, and that's how they make their money. They do all the negotiating, and then you, as somebody who doesn't have millions of dollars or direct connection to, you know, Elon Musk, you got to fork up the fee of 20 to 50% of the profit that you generate based on when you purchased. Cool. And let me know if you guys are accredited investors and want to invest in this. Usually if you have to invest in tech pre-IPO, you have to be accredited. But if you want, I can give you the intro to my friends who do it. What else do I invest in? I invest in industrial. Drew, are you on right now?
Yeah, I'm here.
I invest in Mag Capital Partners, and I've invested in 2 of their industrial assets. I like it because it's cash flow from day one. The way they do it is they buy it with lease sale back. What that means is you buy a factory where there's already a tenant and they own the factory. They sell the factory, the real estate, but they then re-sign as a tenant under the new owners, which is Mag Capital Partners. And because of that, from day one, you can get the 8% pref that Mag usually offers. And they have long corporate leases, like 10, 15 years, right? So if you have a strong tenant and they can pay out cash flow for a long time, it's a pretty reliable way to make money. You got anything else, Drew, that you want to chime in on?
You just nailed it. You just nailed it. So yeah, we syndicate the equity and investments on the industrial side. So, you know, I'll just add a little to that, which is compared to what you were just talking about on the multifamily side, this is a more stabilized investment where we're not going to add value. We have a property that cash flows really well and takes a lot of work to find that, negotiate it, and close on that. But when you get there, this isn't something that requires a bunch of work to, you know, take something that, like you said, starts at a 3 cap and see if we can start generating income at a 6% cap rate, for instance. Usually these are trading at a place where we're able to cash flow pretty strong from day one and increase rents, you know, slowly but steadily over time. So I'll leave it at that.
Gotcha. Oh, another fun thing is that when you have a triple net commercial lease, it's guaranteed rent. It's in the lease, right? They increase income every year because it's in the contract. So, okay. I was looking at some questions. Mohit says, oh, Lipe says, is this profit split with the broker? Yes. For the tech, the profit share, the broker is the one who takes the 20% upside, the one who found it. They usually create a fund, and you have to invest in the fund in order to take, your profits. It's the same thing. The LLC owns the actual equity in SpaceX or Plaid, and then you own a share of the LLC that owns the actual equity. And then if you want to drop your details, Drew, you can reach out to him, or if you want to connect, you can reach out to me afterwards on Facebook. And then multifamily, I invest in a company called Journeyman Construction. They're Austin's biggest developer. Why do I invest with them? How do I know them? I'm roommates with his daughter. That's really it. we were friends in college. And so I've known this guy for 5 years. He was the biggest developer at 2,000 units. Now he's at 3,500 units that he's building. So can you give us some ranges for minimum investments? Okay, so in the tech ones, the broker I'm working with is 50,000 at a time. If you're buying equity as an investor, usually you need like a 7-figure, 8-figure check through industrial. MAG also does 50,000 minimums, but I believe they do 25,000 if you're working with them for the first time. And so MAG does 506B, which is you don't have to be an accredited investor. Accredited means you make 200K or more a year, 300K if you're married for the last 2 years, or you have $1 million in net worth, not including the primary home. So yeah, MAG does MAG does 50K, 25 if it's your first one, and then Journeyman has a $500,000 minimum. So if you're interested in that and you're accredited, reach out to me because I'm putting together a small fund that's only 50 at a time. But historically, he's done 38% on average. He's the biggest developer in Austin. I don't really need to laurel him any further because you guys can just Google him. And so he doesn't really take new investors, but that's the purpose of SARE and how we can ape together strong and invest in a project like in Journeyman Construction. So those are my positions. If you invest in them, good. I have positions in them. I think I have to state that. I haven't taken the SEC license, but just want to give a disclaimer. So let me know if you guys want connections to any of those people. And then finally, where do you find syndications that aren't stuff Nelson's already investing in? If you post that you have money, they will come to you. Ape Together Strong. A lot of newer syndicators will probably DM people. I was doing that when I started out. I do it now when people are like, hey, I have so much money, I need to move it somewhere. I'm like, all right, I guess I'll send a DM. But ideally, don't annoy people because they don't want you to DM them unless they asked for it and they're actively like, hey, I have money, I need to put it somewhere. But if you just say you have money, they're going to reach out, especially in SARE. I know there's probably like 5 or 6 syndicators in this Zoom class alone. So, but I'm going to give some terminology and I want you to clarify who they are within the project. One thing that I do is I'm a GP or sponsor. So I'm on the operation side. So what that means is I am usually in those weekly meetings. I have to sign on the loan and I'm operating with Chris, obviously, he's in this group as well. And then there's co-sponsors in projects. A co-sponsor is somebody who's a capital raiser. Usually they're not on a loan. This is just a legal term that the SEC gives. And so a co-sponsor is somebody who's not in the space of operating every day, but they usually help find money. And sometimes they're necessary because, well, if you think about it, I invested in Plaid through a co-sponsor, right? The actual sponsor operator is Elon Musk. I'm not gonna know and call up Elon like, hey, can I buy equity in you today? No, you usually have to go through a co-sponsor for bigger projects, more larger entities, because there's more people in the middle before you can reach the biggest and most successful operators. And then I also KP. I'm on the loan, but I don't really operate. Technically, that makes me general partner, GP, and a sponsor as well. So KP is a terminology that some people use, where when they invest, they're a passive LP investor, but they are stuck with the loan as well, which I did recently. And so that's just another way to say like, hey, I'm on this loan. When you're asking people too about the operating experience, you usually want to ask like, which ones are you actually operating? Are you just raising, where you're co-sponsoring, or are you just signing on the loan and not really doing anything with it? And your friend is running this. Let's see. Ari asks, how quickly do syndicators usually find all the investors they need? Like if you want to mull for a week, would that be too late? That depends on the investment project. I know for Sam, who works Austin's biggest developer, recently he had a land deal. He was like, do you want to raise for it? And I was like, sure, let me consider it. And then it filled up in 3 days. This man sent out an email. There's no presentation deck. There's no information on even returns that are expected. He sent out an email and raised $20 million in 3 days. Most of his apartment deals fill up in 24 hours, 1 day. And so for people who can raise money, the biggest developers or the biggest syndicators, yes, it fills up quick. If you're in a tougher market, when I started, I was starting in Chicago. Most people didn't know the benefits of investing in Chicago. And so I don't blame them, but it took a lot longer to convince people that this was a good deal. And it took us like 2 or 3 weeks to close with capital raise. Whereas with Austin, it'll fill up very quickly, right? So it just depends on the asset and the syndicator who's operating. Okay, Sumiko asks, what do lenders look for in terms of experience? Okay, so you want to get into commercial real estate yourself, right? That is not what 101 is here, but usually if you are a GP or sponsor operator, then that counts as experience in the face of the lender. If you're just a KP and you're on the loan, but you're not really the operator, you're still kind of an operator. Like in the eyes of, basically if you're on the loan, the lender counts that as you having experience managing it. Am I wrong or right on this, Chris? Or am I too far off? Is anyone a commercial lender in the group? Want to confirm with me? I don't want to feel like I'm talking on my butt.
Wait, hold on. Ask the question one more time.
Sumiko asked, what do lenders look for in terms of experience? What counts as management experience in commercial real estate?
Well, the most important thing is actually be on the loan. So that's one. The second thing is you have to prove that you have partnership and have operation experience. So number one is actually on the loan. So there are different types of loan. Fannie Mae and Freddie Mac normally like to have loan experience in their product. Okay, so if you're only borrowing from your local bank, it doesn't count towards your Fannie Mae and Freddie Mac.
For clarity, by the way, so Fannie Mae, Freddie Mac is your government agency loans. It's the equivalent of an FHA loan, right? It's like an easy box you fit, and it's like the most best stabilized projects. Whereas a bridge loan, which is kind of on the other end, is kind of like hard money. You buy it because you have a business plan to improve the property. So you're going to pay higher interest rates, but they make it easier for you to get rid of that loan so you can go into your refinance and get a good, stable government agency loan, right? But yes, basically, once you're on the loan, that actually counts towards your management experience in commercial real estate. A lot of people just raise money sometimes for bigger GPs or sponsors, and that will give them the foot in the door so in future projects they can be on the loan. But it depends on the syndicator, what you need and how much you need to raise, right? Hope that answers the question.
Thank you.
Hi, Sumiko, by the way.
Yeah. Okay, Drew recommended to Ari, I would recommend asking the sponsor if they take a soft commitment while you do your due diligence. So this is pretty common as well. When I say, by the way, that in 24 hours he filled up in soft commitments. So what that means is, hey, day one, I want to put $500,000 in, and then you still get 2 weeks before the money actually has to hit the bank, right? That's something to clarify with your sponsor. But pretty much once those spots fill up, a lot of times they kind of fill up and you just have to be in the wait list while everyone else does their mowing. So if they just have soft commits, oftentimes it's not bad to just say, hey, put me down and I'm going to take 2 more weeks to like do the math on it. And you can still back out, but you know, just an idea for the sponsor to figure out, am I going to get close to this raise? How much more people do I need to contact, you know, et cetera, et cetera.
I presume those are all PPM, those all require PPM, and right?
Yes.
Generally. Okay.
Yeah, by that stage, you should have a PPM and operating agreement. So PPM is private placement memorandum, and then you have a OA, which is an operating agreement, both of which will indicate, you know, all the legal stuff, like how much distributions and all the risk you got to take. And that's what you should send to your lawyer. Okay, Jill asked, how much money ideally should a person have set aside in order to play? Can a person with 30K in the bank start doing this? Or should the person have at least 50K or 100K to start getting involved in this sphere? You can invest however you want, but usually there's a minimum of 50K for most syndications, other than MAG, who does their first 25K like for their first time. So like that might be a good way to get your foot in the door, get to know the syndicator and how they operate, because that's what a lot of people do as well. They usually put a small portion the first time and see over like, you know, 1 to 2 years, does this person communicate well as a sponsor? Are they getting me in, keeping me in touch in case there's any issues? And are they paying, you know, out on time? So like you can put small amounts, you don't have to put the full amount. It's a way to test the waters for sure, but usually 25K is what I've seen as the minimum for MAG, and everyone else I've seen just 50, right? So, but yeah, let me know if you want to start the conversation. Chris Seychow asked, what is a good resource to learn more about syndications? So that brings me to this cash flow portal. How do I stop sharing screen? Okay. So cash flow portal is a way that one of the members in this group has created to help people invest. So give me 1 sec.
Yeah, the question about where to find syndication information, you can visit my website or hit up Nelson. You're on mute, Nelson.
Yeah, you can hit up us or you can find other people, because obviously I don't want to sound like I'm trying to pitch you guys. Let me see here. So cash flow portal is a way to go in and invest and find deals. That's secret. That's how do I make this work? Is Perry, are you in the group? Is everyone cash flow portal in the group? Right now? Okay, is this investing? Okay, cash flow portal is a way to find basically more syndications and investors. I'm not too familiar with it myself at the moment, but I'm going to figure it out at some point. The other option to figure it out is we've been creating a Sarah Notion to help people get started in real estate. And so actually go a little more in depth here on the syndication space, breaking down the same thing I mentioned earlier, syndication versus joint venture. I give samples and what you should see. A lot of times in preferred returns, you'll see 6 to 12%. My friend, for example, he offers 20% though, like they're way out the range, but because they do 20%, they don't give you any of the equity profit split, right? You can just expand this and see the same slides from earlier. If you're curious about where that is, just go to subtlerealestate.com. There should be like a black button right on the front page that says like Sarah Wiki Investing Guide, go to syndications. You want to check your cash on cash income. This does not include sales proceeds. But the idea is that while you're operating, you want to make sure this person has enough cash on cash return to pay the preferred return that they're offering, right? Some people can offer 10% preferred return, but it's because you don't get paid until year 4 of the full 10%, right? And so that's something you want to double check. But again, required that. IRR is a term to learn as well. Most people will generally say 14%. 14% IRR. It's usually higher for new development because usually more risk, there's less payment, but you get a bigger payout at the end. And so the idea is that time has a value, and the longer it takes to pay out the bigger chunks of money, the less that dollar is worth, right? I would rather, get paid and double my money tomorrow instead of 5 years from now, right? So that's how people take into account the time cost of money. I have fees here that you guys should double check, confirm that with your sponsor. Everyone usually charges an acquisition fee. That's 1 to 5%, depending how good the deal is. Refinance fees, disposition means when you sell the property, there's a fee for that. And the fee is percentages of like purchase price, but also construction budget or revenue, right? It's not always from the same pool. So the percentage fee, it depends on where it's coming from. And usually that's used to pay ongoing expenses. Like, for example, acquisition fees. Chris Tao is hiring has 2 employees who are constantly looking for deals. 3.
Oh, yeah, I have 3 employees. One focus just on looking for deals.
Yeah, managing the asset, organizing meetings. Drew, do you guys take you guys, I don't know how big your staff is, but most of the time that fee is just for paying ongoing costs. Like, Drew, do you know how many people you have right now on the company?
Yeah, we have 12. You said acquisition fee?
Yeah. Yeah. Well,
yeah. Generally, that's for most sponsors. That's paying overhead. It's pursuit costs. All of that is time, labor, staff, all of that. So, and I always point out to people, if you've ever done active real estate investing and had a deal not work out, sometimes you eat some money or at least some time. So it's always nice if you're investing with a sponsor, they're taking on that risk, because generally speaking, if it doesn't work out, they pretty much eat that pursuit cost. So something to keep in mind.
Yeah. That being said, I know I kind of glazed over red flags and syndications because, again, this is 101. It's going to be too long to take a deep dive, but here's some red flags to keep track of, especially for the deal, the market, and the sponsoring operating team, right, to keep track of. And then just frequent questions that people have asked. I'm going to keep filling this out, especially since so many of you asked good questions tonight. I'm going to keep adding to this list.
These 3. That's what I tried. Oh, no, this is online. You can access it.
Okay.
The website? Which website? I think it's just the one, the one on the Facebook page. Because they have a Notion.
Oh, hey there, who's speaking?
Not into it.
No, I haven't seen the Notion.
Yeah,
They have a shared Notion?
Yeah.
Are you sure?
Yes, they literally just said it, and I've already seen it before. I already went through your website.
Does anyone know how to mute someone else? Okay, I'm just gonna keep going. Okay, so frequently asked questions, things you can search up there. Okay, Alex asks, how does being a KP or JV affect your personal credit or DTI? Okay, so Alex asks, in order to be a KP or JV, it doesn't actually affect your DTI, I'm guessing, because actually, no. That's a good question. Well, so there's 2 parts to this. It depends on which entity you're holding into. It'll affect your personal credit because you get dinged for your credit check when you sign up for the loan, right? Usually they do credit checks. However, when you KP or JV, a lot of times you create an LLC. So it's not affecting your DTI, it's affecting the quote unquote DTI of the LLC. You see what I'm saying? So it's the LLC has its own credit score and its ability to like borrow, but you as the KP or JV, it doesn't actually hit, it's not like a personal, it's not like a personal DTI that you have to watch out for, unless I'm not a lender on this one. So I might be, I might be a little off base.
So Nelson, I recently was kind of the KP on the Walnut Flats.
Yeah.
And apparently they didn't even run my credit. They just needed a financial statement, proof of funds, or proof of liquidity. I don't know if that was an anomaly or.
So we bought a 30 unit together recently. I had my credit run. What the heck? I checked my credit score. It got dinged recently. Okay. But either way, we held it within an LLC, so it's not really affecting my DTI. That's the only way I can explain it. If there's a lender who knows better, feel free to step in. But generally, it's like if you have it in the LLC, it's the LLC's credit. You just get dinged because they do personal credit checks sometimes, apparently.
I could help answer for you guys. Regardless if you're gonna put it in the LLC or you're gonna put it in your personal name, depend. But if it is commercial loan, it's not gonna count against you under your DTI.
Got it.
So, because obviously if you own multiple different, homes, they're gonna ask for your tax return. They're gonna see that K1 that you're gonna get every year from that commercial or syndication that you guys getting. They're still not gonna hit you against your DTI because at the end of the day, it's commercial. They don't know if you own it yourself or you own it, multiple different partners.
Yeah. And also commercial side, we usually buy $10 million at a time. Having that hit your personal credit, nobody's going to afford anything anymore.
Yeah.
Yeah, they pull your credit largely, as in my experience, so that they know what rate to set at. They often use it as like credit worthiness, even commercial loans.
Gotcha.
Super annoying.
Okay.
Yeah.
Jason Kane asks, what's the best advice you can give regarding mindset and choosing co-GP partners when putting together your first fund? So Jason, I remember you're raising for an Airbnb fund. I think when it comes to mindset, it's a question of, whose best interests are you trying to address? I know some GPs, they care more about the product that they're creating, right? Especially in Airbnb, it's like, I want to create the best product. I want to be the top Airbnb. But if you're partnering with people who are like, let's save every dollar that we can, that might get in the way. So one is, how are their financial spending habits related to yours, right? Are they in a growth of revenue mindset, or are they in a minimize expenses mindset? And so that's one thing to address. The other one is, how risk averse are they, right? Are you taking on, bigger projects and you're paying full, like a little over asking price just because, you want to capture as much revenue as possible? Or are you somebody who's trying to wait for the best deal and get the biggest discount and take your time to find something? And so, those are things that will matter as well in the long run, just because, when you first start out, you might be worried, but it's worth it just to test one or two projects with somebody. You don't have to be married with them. Just create separate LLCs and then focus on co-GPing afterwards. Like, I like working with Chris. He's always been very transparent with me. But I've had other partners in the past who just don't really tell me anything that's going on until an issue arises. And then they're like, hey, we're gonna need you to put 15 grand into the project in order to keep it alive. And so, and it's like, oh, well, when was this an issue? 2 months ago, so it's stuff like that might matter, but it's something you have to be careful of. And a lot of times, usually you want to just partner without investor money first and your own money. So that way no one else is at risk, especially if you're working with somebody for the first time, right? So, okay. Peter Yee mentioned, Peter loves PennyMac. He's got 3 loans with them and they allow 15% down for investment properties. Chris mentioned know, like, trust. If you run a fund, a lot of times it's better to meet the GPs in person, ask to see their financials, and visit how they run their properties. Drew asks, Drew mentioned, I find that if I ask any sponsor on the first time, they'll take half of their minimum. It's usually worth asking if you're looking to deploy a lower amount. Yeah, it's like how drug dealers do it. You give a little bit first, and then hopefully you get them hooked on the rest of the deal. So, Wilson Lin, for the final profit payout on the exit, That's subject to capital gains. Correct. It is capital gains, and you can actually 1031 into another syndication. Now, that being said, you're actually not allowed to 1031 unless everyone agrees in the current syndication to 1031 together into the next syndication project. So that's the downside. You can 1031 into a syndication, but it's a lot harder to 1031 out because everyone has to agree to 1031 on the sale. So let's see. Lipe asked, who are the buyers usually at exit, given that the seller has taken so much of the meat off the bone? Lipe, great question. So here's the trick. You don't actually rehab everything. You leave like 25 or 30% of it unrehab. So the next buyer is okay with no meat on the bone. The other person to sell it to, especially once you get to 100 units, around 100 units and bigger, you get a lot of institutional and family offices and basically really, really wealthy people who don't want to do work updating properties. They don't want to do work changing things. They just want it to fit within their fund and collect, maybe a lower amount, but they don't care about the equity increase. They're already rich. They just want stable income to offset all the other money that they have. They're in preservation mode. So your ideal buyer is somebody who doesn't actually care about the meat on the bone. It's somebody who just wants a stable asset, either usually hedge fund or a family office. People with a lot of money who just want to diversify. If you talk to other syndicators, they're just going to know you asking you for a bigger discount, basically. So, okay, Earl asked, the other partners may not want the 1031. Yeah, so basically you can't 1031 unless everyone agrees to 1031. Some deals, Bui mentioned. Huh?
That's what I thought. Like, I thought you couldn't do that. Like, yeah, thanks for clarifying that.
Yeah, you're not supposed to be able to unless everyone agrees to do it, basically, because it's a whole LLC doing 1031, right? Okay, Buitan, some deals also offer using retirement accounts which aren't subject to capital gains. That is correct. So if you do a self-directed IRA, you don't pay capital gains on the sale. So if you're earning, say, on average 38% a year in awesome new development, you double your money every 2-3 years, and so you're allowed to not pay taxes when that project sells if you do a 1031 or if you do an SDRA. So Bui mentioned traditional subject to taxes on gain. Only Roth accounts are excluded because it's post-tax money. So let's see. Oh, Arthur wanted to clarify and tell people, by the way, sponsors don't usually get paid at all until they sell or refinance. So the fees help them stay afloat while working full time. That's correct, because if you pay an 8% preferred return, usually that's because there's only 8% cash flow. So all of it goes towards paying back the investors in terms of like the running fees. The sponsors usually make money once it refinances or sells, because then you don't have to pay the pref anymore. And so you can take some of that money and put it towards actually, like, paying off your employees and staff. Liz asked, will there be another class on this above 101? We'll probably do 102. It'll be about underwriting for multifamily, likely. John Chen asks, is there any recourse on the loan for an LP? No, that is the purpose of being an LP in a syndication. If you are a recourse on the loan, then you are probably co-signing, and therefore you are not an LP. You're either a KP or an operator without realizing you're an operator, which isn't great because you're on the hook for the loan. You should watch out for that. John, you were on the loan for that 8 unit though, so you technically have commercial experience in the eyes of lenders.
I see. Yeah.
Okay. Wilson said, if everyone agrees with 1031, but one or more investors fails to identify and exchange property, that would kill the entire 1031. So to clarify, it's literally one whole LLC saying, we're going to buy this LLC or we're going to buy this next property. We as the LLC is 1031ing from one apartment to the next. It's not that each investor has to find a new property. Everyone usually 1031s together into the next project because you have to, because the LLC chooses to, not the individuals, right? The individuals, you're part of the LLC 1031s, not the individuals, to clarify. If there's one person who doesn't want a 1031, what you can do is buy them out. So the rest of the group can 1031 together, is what Tony Lin mentioned. That being said, I now have access to Cashflow portal. Give me one sec. So this Cashflow portal, it's a way to find and connect with sponsors. And this is your friend, Nelson here. I actually have to change this soon because I just signed the loan and I belong somewhere else. But there's a bunch of other people on here as well. And it's a way to find and connect with sponsors. Hua and Jaime are actually, they were in the trip for Texas. So if you guys were there, you probably would have met them. And so here is, here's a breakdown. Basically, you can join the deals as investors. It helps you keep track. You have documents, profiles, and you can check the marketplace for all the other sponsors, right? This allows you to connect by location, markets, assets for whatever it is you're looking for. And then if you decide to switch to syndicating, if you're a syndicator yourself, this is a free way to set up. They charge money once you start raising capital for it, but you actually distribute, pay out your investors and all the people who signed up. You can connect them through your bio, set it up so people can figure out who you are. Like for example, if you preview my biography, you could figure out, hello, I'm Nelson, I'm in Austin, blah, blah, blah. I'm co-sponsoring, I'm lead sponsoring, and I'm looking for people to invest, co-sponsor, asset manage, and be boots on the ground, right? You can figure it out by also just, looking at my bio and the open investments I'm in and the ones that I'm sponsoring, right? These are two of the projects I have in Chicago, one in, San Marco. So that's Cashflow portal. Hopefully it's beneficial for y'all. You can check it out later. But that brings me to the end of this class. And so we're going to do a 102 probably around underwriting and how to analyze deals. Perry's actually in the group for Cashflow portal, so feel free to reach out to him directly. And yes, I am recording this and posting it directly to Sarah. Hopefully that covers it for everyone. I'm going to plug myself. If you guys want to email me, feel free to reach out about more stuff or just reach out on Facebook. And so, yeah, have a good night, everyone. That kind of leads to it. I don't really have many other announcements. Thanks again for chiming in, Drew, Mohit, Chris, and all the other sponsors who are involved, and for Cashflow portal for being like a syndication software. But yeah, have a good night, everyone.